A very good morning to our MIIM members and friends in Germany, and good afternoon to our participants joining from India. Thank you for joining us today for the webinar Decoding India's 2025-26 Union Budget, organized under the Make in India Mittelstand program in association with our MIIM partners Khaitan & Co. and Rödl & Partner. Rödl & Partner is the knowledge partner for the MIIM program, and I am Maya Yadu, the MIIM project coordinator for Rödl & Partner in Pune, India, and I will take you through the session today. Before we continue the session, let me briefly explain the technical side of our program. The following functions are available to you. In the upper right corner of your screen, you will find the control panel. Here, you can adjust the audio settings and choose, for example, between your headset or the computer audio. Please note that as a participant, you are muted by default. A bit further down the dashboard, you will find a question panel. We request the attendees to please post their questions in the question section, and we will take these up in the last leg of the webinar during the Q&A. Allow me to very briefly introduce the Make in India Mittelstand program to you. Make in India Mittelstand, or MIIM, is an initiative of the Department for Promotion of Industry and Internal Trade, DPIIT, and the Embassy of India in Berlin. MIIM provides a platform that integrates a wide range of support services for German Mittelstand companies and family-owned enterprises. It is part of the Make in India initiative of the Indian government and is a program designed to facilitate investment, foster innovation, enhance skill development, protect intellectual property, and build best-in-class manufacturing infrastructure. The MIIM program offers all support services like strategy consulting, M&A, operational market entry support, tax and legal support, financial services, project financing, location services, technology collaboration, and facilitation of approvals from central and state government agencies under a single umbrella. Part of the MIIM program is today's informative webinar, in which our speakers will decode the union budget for you and share their professional opinions on the changes and announcements within the 2025-26 union budget. But before we delve into the details of the union budget, I'd like to invite Dr. Dinesh Antil, First Secretary and Head of the Income Tax Overseas Unit and Economic and Commerce Wing at the Embassy of India in Berlin, to deliver his welcome remarks. The stage is all yours, Dr. Antil. Thank you for being here.
Thank you, Maya. Ladies and gentlemen, a warm welcome to this webinar on Decoding India's Budget 2025. Many of you here would be aware that India is the fastest growing large economy in the world. It is defying the current global economic trend year after year and records a handsome GDP growth consistently. Behind these outcomes lies a determined policy thrust to create an enabling environment for economic activity, to address the challenges that investors and businesses face in achieving optimal outcomes. And the budget 2025 is yet another step on that trajectory. It has a host of measures aimed at enabling ease of doing business, strengthening physical and digital infrastructure, supporting domestic and foreign companies in doing business in India. While on one side, it brings in incentives and ease of doing business for the enterprises, it also aims at boosting demand in an already bright Indian market. We and our partners in the MIIM have been able to bring together a set of experts dealing with various aspects of that are covered in the union budget, and I'm sure that going forward this session is going to be extremely educative for you. And of course, if any queries arise after this, we remain at your disposal to address them in detail. I'm thankful to the experts for taking time out of their busy schedules, and also to you, the audience, ladies and gentlemen, for being here with us. Looking forward to a very productive session ahead, and also a very good association afterwards, after this session, with all of you. Thank you. Let's begin.
Thank you so much, Dr. Ante. Okay, so our next speaker for today is Gaurav Makijani. And Gaurav Makijani is an associate partner at Rödl and Partner and a qualified chartered accountant and postgraduate in business finance from Symbiosis University, Pune. He has 14 years of diverse experience in corporate and international taxation. Gaurav's key areas of expertise include corporate tax strategy and planning, tax due diligence, tax and regulatory aspects of mergers and acquisitions, inbound investment advisory, and structuring cross-border transactions. And without further ado, with this short introduction, I'll hand over the virtual mic to my colleague Gaurav.
Thanks, Maya. Is my screen visible?
Not yet, but I think it must be coming up. Yes, now it is. Perfect.
So, good morning, ladies and gentlemen. Without wasting any time, I'll switch on to our agenda for today. And in first of all, in our presentation, we have covered some economic indicators because whenever there's a budget introduction, of course, there's a background of how the country is doing, what are the economics. So, just highlighting few aspects of important economic indicators on where does India as a country, as a nation, as a investment hub stand. So, as many of you would have already know that in 2024, India had a general election, and Prime Minister Modi had given his third tenure as a prime minister. Now, in terms of GDP growth, we are expecting somewhere around 6.3 to 6.8% in next financial year, and we were able to achieve 6.4% in the current last financial year. Now, this when we compare it to the global GDP growth, it was 3.3%. So there you can see that India is among one of the highest major economies in terms of best GDP growth. In terms of gross FDI flows, again, India has shown the growth of 17.9% from $47.2 billion to $55.6 billion in financial year 25. As far as foreign exchange reserve is concerned, now you see a major growth here. We are currently at $634.6 billion as a forex reserve, and this is actually enough to repay 90% of the debt which India has. So it shows a very, very strong position, very stable government, very stable economy as far as a foreign investor looking at India as an investment destination is concerned. Even when we look at the fiscal deficit numbers, we are able to achieve less than 5% goal, which we had set. 4.8% is something which government has achieved in the last fiscal year, and government is now targeting 4.4% as a fiscal deficit, which also shows India at a better footing in terms of borrowings. Now, coming on to the direct tax proposal, here there's no major change in corporate tax rate as such. So for all the foreign investor investing from Germany to India, it shows kind of a stability that the Indian government is providing, that there is no fluctuation in the tax rate. The tax rate are already at a very, very low level, and when we compare with the Asia Pacific, for example, for corporate tax, the corporate tax rate is around 22%. With some surcharge and cess, the corporate tax comes to around 25%. But for some manufacturing company, the rate is as low as 15%. With some surcharge and education cess, which India applies, the tax rate gets to around 17%. Now, there was a very interesting announcement made by the finance uh, in this budget, wherein it was announced that a new income tax bill would be placed before Parliament. And this is something which has already been placed. The idea is that the current Indian income tax law is a little complicated. So to make it very, very easy in terms of the language, in terms of improvising in section, etc., the new income tax bill has already been placed. Now, this is before the Parliament. The discussion would be undertaken, and the idea is that from 1st April 2026, the new income tax bill would become a law and would then be applicable in India. Idea is only to improve the language to make it easier for also laymen to understand. But the broad perspective is that there is no real changes to be brought in as far as the income tax is concerned. So, as a German investor, I should not be worried as to what would be the income tax bill. It's just the making act a little easier to understand. And the next point, for as I mentioned, for manufacturing, few manufacturing companies, the tax rate is around 15%, and the effective tax rate is 17%. Now, this is applicable only for company who has been established after 1st October 2019, but has started the production before 31st of March 2024. But after 31st March 2024, if a company start the production, this is the reduced manufacturing rate is not applicable to those corporate. So a lot of representation by the industry, by the association were made to the government that you also then extend the sunset clause of 31st March 2024 further, because there was Ukraine-Russia conflict, there was global supply chain, geopolitics issues were going on. So it took a lot of time for investor to actually uh, take advantage of this particular scheme. But government feels that as of now, India is already providing the best tax rate as far as Asia Pacific is concerned. So there is no extension made in this reduced corporate tax rate. Now, coming on to a few key amendment from international tax perspective, there is very interesting presumptive taxation scheme which has been brought for non-resident. So any non-resident who's providing any services or technology to any resident which is into setting up of electronic manufacturing facilities, then a non-resident has an option that I can presume that my income, 25% of my total income, the receipt which I'll get from the Indian resident, would be considered as my income component, on which the tax of 35%, which is applicable on foreign company, would be applied. So the effective tax rate on that would be less than 10%, because if I assume that there is €100 of income which I receive from Indian resident, I apply, or I assume 25% of that 100 is the net profit which I earn from that particular business, and then I apply 35%. So the effective tax rate would be a little less than 10%, which is better than the fees for technical service rate, which is there in the treaty, the very beneficial rate in the treaty of 10%. It's even beneficial than that. So this is something new which has government has brought in from this year, and one can look at if you are providing services in this regard and you fall in this category, you can take the advantage of this presumptive scheme. Government has clarified on this significant economic presence. This is a concept where a German company or any foreign company may create a permanent establishment, a business connection in India. But government with this year has clarified that in case you are sourcing from India, you're only purchasing from India, then you do not need to worry. There would be no tax implication on India. The business connection would not apply. So this is again a welcome step that has provided a clarity when a German company is purchasing goods from India. Now, as far as OECD Pillar 2 is concerned, there was some speculation that government would come out with some regulation for OECD Pillar 2. This is something which is applicable in EU already, in Germany already. So the idea was the government in India would also bring out with some rules how to cater to the OECD reporting requirement. As of now, there is no reporting requirement as such. So for a German company having subsidiary in India, anyway, this is something which is not a concern there. But in case you have to do some reporting in Germany and you would need requirement from your subsidiary in India, you will have to then coordinate on what reporting or what accounting standard, tax standard the subsidiary is following, and in what form those subsidiaries should send you the details. So even though there is no OECD pillar to update in India, there is no requirement, but still as a subsidiary in India and a headquarter in Germany, because this is something which is applicable in Germany, you need to take care of this and then ask your subsidiary to provide a requirement in a particular format. On certain procedural key amendment, there's a concept of gift city, uh, which is a area special economic zone in Ahmedabad, near to Ahmedabad in Gandhinagar in Gujarat state of India, Now, to promote it as a financial hub, the government has provided various incentive to if a company wants to invest in a gift city and operate through a gift city. There are a lot of tax benefits which a foreign company, a German company can get. Uh, Generally, this is applicable to all the financial institution, banks, insurance, etc. But even for a manufacturing company who is looking to make in India, concept of global treasury is something which is provided by the gift city regulation. So one can look at if you want to open a global treasury function in India in the gift city, you get a very nice benefits in terms of tax deduction. 100% of your profit becomes exempt from income or deductible for a certain period of time. So this is a very good scheme if you are looking to invest further in India. A gift city global treasury function can be looked at. In terms of other procedural changes, there's a concept of startups. So government to promote startup culture in India provides tax deduction. A startup can get a tax holiday period of 3 years out of 10 years of their choice. Now, here also the sunset clause was until 31st of March 2025. So any startup which is starting before 31st of March 2025 was eligible to get this tax holiday. So the government to further promote the startup culture in India and to promote new startup as well has extended this deadline from 31st of March 2025 till 31st of March 2030. So any startup now incorporated in India can avail for the scheme and get 3 year tax holiday out of 10 year of their choice until 31st of March 2030. Then on TDS and TCS collection, which is a withholding tax collection or tax collected at source, a domestic provision which may be applicable to your subsidiary in India. The rules were that in case you are either withholding tax and then you were not able to deposit this TDS or withholding tax, or even if you are required to collect tax but you are not depositing that tax to the government as per the prescribed time, then there were criminal proceeding which could have been initiated against the taxpayer. The main moot reason for this criminal proceeding was that in case you have withheld tax while making payment to any vendor, now this is something which you are collecting on behalf of the government. So the idea was that you have collected something from the vendor and then not paid to the government. This belongs to government, but you have not paid to the government. So government then wanted to ensure that the compliance is made. The taxpayer does not keep government money with itself and utilize it for its own disposal purpose. To avoid that scenario, the government has introduced criminal proceeding. But to relax certain aspects here or to provide some breathing space to the taxpayer, the government has provided that in case somebody forgets to deposit the TDS or TCS withholding done collected on time as per the prescribed limits, but is depositing the same amount before due date of filing of the respective statement, which is a quarterly in nature, then again in that case criminal proceeding cannot be initiated against those taxpayers. So this is again a welcome move make for ease of doing business in India. As far as mergers and acquisition is concerned and updated tax return is concerned, there are few development which government has introduced. So there was a concept of carry forward of business laws for amalgamation and reorganization. So what used to happen is that in case you are undertaking any merger, acquisition, or any restructuring in India, so the carry forward of business laws was allowed from for next 8 years from the date of amalgamation. Now, this was creating challenges for the government because it was always providing evergreening clause of losses. For example, if I am doing any merger today, I was able to take the losses which is standing as on today for next 8 years from the date of merger. And if I undertake any merger today, my losses are eligible for next 8 years, which can be carried forward. Assuming that after 5 years of the merger date, I again do some restructuring in my organization, I would again get next 8 years from the date of second merger. So that's how the taxpayer were taking this benefit and evergreening those loss situation in terms of carry forward and offset. So the government wanted to plug this so-called loophole in the act and has clarified now that the idea is that whenever business loss is incurred, it can be carry forward an offset uh, for the period of 8 years from the date of original loss when it was actually incurred, even though there are multiple merger, it should not evergreen those losses. So this is something which was a loophole, lack of clarity, which government has clarified. So for any merger which you are undertaking in India, this is something which you need to plan, that now there is no evergreening losses offset provision available. And in case some merger is already pending before the National Company Law Tribunal and is completed before 31st of March 2025, then of course you get 8 years from the date of merger. But if the merger is approved 1st April 2025 or afterwards, then in that case the losses would be available from the date of first incurrence of the losses. Now, on the updated tax return, this is something which is a new scheme brought by government a few years back. The idea was that in case you have an Indian financial year which runs from 1st April to 31st of March, and the due date to file the tax return for corporate with the transfer pricing applicable provision applicable was 30th of November following the financial year. And if you have to either revise the return or maybe have forgotten to file, missed to file the return and have to file the belated return, you could do so by 31st of December by paying a very nominal fee. But government had provided another option that in case all these deadlines are missed, there is a risk of penalty and interest which can be levied in case I fail to file the tax return in India. So to provide some breathing space, the government has provided additional option that in an updated tax return can be filed up to two to three, 3 to 4, or 4 to 5 year bracket has been given, and some additional amount, which is 25% of the tax which was originally required to be paid, has to be paid, and then the updated tax return can be filed. For example, if I have already filed my tax return in year one by 30th of November, but I've missed to, for example, disclose certain part of income, somehow it got mixed, and that's say €100. Now, the deadline for revising the tax return has expired by 31st of December, and I noticed this in say next year in February. So in that case, I can utilize this option of updated tax return. I can pay 25% of the tax. So assuming that the €100 is the amount of income on which 10% fees for technical services has to be paid. So €10 is the amount of tax. 25% of €10, which is €2.5, I have to pay as an additional tax, and then I can file the updated tax return. The benefit of this is that in that case, I would not be levied a penalty, and it is inclusive of interest. So that way, I have disclosed all the income which I have generated from India, providing me a breathing space in case I miss something. There's no penalty exposure in that case. So that's again a welcome scheme. And in this year budget, government has actually extended the timeline from 3 years to now 5 years. So even though you realize that some income has been missed after 3 or 4 years also, you can then file your tax return. But you have to pay 60% and 70% additional tax. Now, on prima facie look, you may feel that okay, 60% of the additional tax is quite high. But if you look at the interest component, if you had, if tax authority ask for you and they notice that you had not disclosed this income and the tax is payable on this, so they would add 1% per annum interest on the tax plus the penalty. So by here, if you see from 2 to 3 years, from 50%, you just pay additional 10% even after 1 year. Otherwise, you would have paid 10% of interest plus the penalty. So you are in any case in this scheme saving certain portion and avoiding any sort of tax litigation here. So again, a welcome scheme there in terms of additional timeline given for filing the updated tax return. Then there is a domestic tax regulation of TDS, TCS, as I mentioned, withholding tax. There was a requirement that whenever I'm selling any goods to any other party, one domestic company selling goods to another domestic company in India, maybe a subsidiary of a German company, if the amount of sale to that party was more than INR 5 million, I had to actually collect 0.1% of the tax on sale of good. Similar requirement was on the party who's purchasing, that they have to withhold tax. So there was a lot of confusion here, and representation were made whether I should collect tax or the other party purchasing goods would withhold tax on the payment. Government has now removed this clause altogether. There is no requirement to collect tax. Only requirement is that the purchasing party has to withhold tax if the threshold is met. So all in all, a lot of rationalization in terms of this provision has been done. So prosecution has been relaxed, and also unnecessarily provision which were there and were creating complicated. Government has identified those provision. Representation has been heard, and altogether, in nutshell, the complicated provision has been removed to make ease of doing business in India in terms of TCS provision. Again, there was higher TDS and TCS clause. So in case I have to withhold tax on any payment to a vendor, there was a requirement that I first need to understand whether this withholding tax is applicable or not. If yes, then what is the tax rate on which I have to do the withholding? And again, there was a requirement to check whether that vendor has filed its return of income or not. In case the vendor had not filed its income tax return, then the rate which I had to apply has to be double as prescribed rate. Now, this was creating again a lot of confusion, and representation were made before the government that I cannot, as a person, as a businessman, should be responsible to check whether the other party has filed the tax return or not. So the government, to provide this benefit relief, has now removed this provision altogether. Now, as a domestic company, whenever I am making payment, I only need to check whether withholding tax is applicable and at what rate I have to withholding, and that's the end. So this was the major implication from the corporate tax side. Many of you might have heard, it might not impact most of you, but for individual, India has exempted the income from up to 1.2 million. There would be no tax. Now, this is something which is surprising, or maybe surprising for a lot of Europeans also, because I was talking to few clients in Germany, and they were actually informing me that this is something which is now equivalent to Germany, or even more beneficial than what German government is providing to German citizens. So that way, you see a lot of disposal income is being given to individual, which would create a lot of consumption. And because India is a market economy, it would make the market even more interesting, more effective when people have higher disposable income and they hand. So again, the idea is to promote businesses in India. Government has also on the sideline have changed the slab rate. So India follows a progressive tax rate, which is same, I think, in Germany. So the slab rate have been changed, which reduces the tax implication, even though my income is more than INR 1.2 million. So even if I am earning more than INR 2.4 million, where the tax rate is 30%, I would get 100,000 INR in terms of annual benefit as a tax saving. The last point which I wanted to cover in my presentation was on the transfer pricing. Now, the government has proposed an introduction of block assessment for transfer pricing. It's uh, the rule is that in case my assessment for transfer pricing is done in year one, and my year one, for example, is with no adjustment done, and in year two and year three, my transaction, the international transaction, are with the same parties, and the quantum, or at least the percentage plus the benchmarking requirement, remains the same. Overall, there's no major change in the international transaction between the parties. In that case, I can approach the tax office and say that the order for year one should be automatically applied in year two and year three, so that I do not have to again undergo the entire lengthy process of proving that the transaction between the related party were at arm's length. So again, a welcome move. There are some aspects which is not clear so far. Representation have been made. There is still discussion going on in the parliament. Rules are yet to come out. So we'll see how this follow. But as a starting point, this is very interesting mechanism. And in case I have a clean order from a transfer pricing officer in year one, this is something which I can then utilize in year two and year three. So again, very, very welcome move. This is something which is available in very many developed nations. For example, US has this rule of 5-year transfer pricing block assessment. Germany also has similar kind of rule. Uh, it is little different in that case, but the idea is that it should the taxpayer should have this option of block assessment. So this was it from my side in terms of income tax. Happy to take any question at the end of the webinar. Thank you.
Thank you so much, Gaurav. And that's also what I, of course, encourage our audience to do. If you have any questions, I just repeat myself, please just feel free to post them in the questions panel so that we can take them up in the end. Coming to our next speaker for today is Sudipto Bhattacharjee. Sudipto is a partner with Khaitan and Co. He's a lawyer with more than 19 years of experience specializing in advisory, investigations, litigations, and contractual disputes under GST and other indirect taxes. Sudipto has been repeatedly recognized as an indirect tax leader for India by the International Tax Review and has been recognized as a litigation star for tax in India by Benchmark Litigation Asia Pacific Rankings last year in 2024. Without further ado, I'll hand over to Sudipto. Thank you so much for being here, and we look forward to your insights.
Thanks, Maya. Very good afternoon to all of you. I hope my slides are visible. The screen is visible.
It is. Yeah, perfect.
Okay. Then without further ado, let's dive right into the indirect tax proposals. We'll start with customs. And I think one of the significant developments that have been amendments that have been proposed this year is a time-bound finalization of provisional assessment. An amendment has been proposed in Section 18 to bring in a 2-year timeline for finalization of provisional assessments. Now, why this is important is because it has been, and some of you might have yourselves faced it vis-a-vis your Indian subsidiaries. There are often massive delays in finalization of provisional assessments, especially when the imports are being done under the claim of an exemption or concessional rate on the basis of a free trade agreement. If there are valuation issues, especially in the context of a related party valuation, often provisional assessments are opted for and they just keep going on and on before finalization happens. And this is something that has been flagged by the Controller and Auditor General of India, because this not only hurts the SSEs, this also prevents the government from having a clear, certain view of the revenue that is expected to come in from the custom side of it. From the importer's perspective, what happens is there is a 5-year timeline, a look back period for issuance of show cause notice, but that doesn't even start until the finalization of the assessment. So till the time the provisional assessment continues to be provisional, basically the sword of a reassessment, sword of a litigation, or sword of a customs dispute continues to hang. And this has been a sore point practically for many importers. This is many representations have been filed, and I think as a consequence of this, as a ease of doing business, as a facilitation measure, this timeline has now been introduced of a 2-year plus a 1-year extension if allowed. There are some reasonable exceptions, in cases where information is required from a foreign authority by way of a legal process to finalize the assessment. If there is a matter is sub judice before Sestat or before the Supreme Court, High Court, if a stay has been granted by a court, if there's a specific order from the Central Board of Indirect Taxes and Customs to keep such matter pending, so on and so forth. But apart from these, one hopes that the timeline that has been introduced will be adhered to, will be implemented. And which brings us to some of the talking points, some of the points for deliberation. One, of course, is how has this 2+1 year time limit been arrived at? It's not very clear, because if you look at whatever precedents we had, I mean, there was customs finalization of provisional assessment regulation of 2018, which prescribes a 3-month time limit. Then the predecessor to that was a CBEC manual, which prescribed a 6-month time limit. So from there, a 2+1 year, it appears that the government is trying to take a pragmatic view, something that would be possible on ground to be adhered with. But I think somewhere this question will come up, that how have we moved from 6 months to 2+1 year, the reasonableness of it. Pertinent to point out that the Jharkhand High Court in the case of Bihar Foundry Customs held that delay in finalization of provisional assessments beyond 6 months was barred by limitation. So they, basically implemented and gave a very strict interpretation to the 6-month timeline prescribed under the earlier law. One has to see how this will be affected, whether a similar sort of implementation will happen in the context of these timelines. Because the problem is that while we have the law says it shall be completed within this 2 plus 1 year timeline, what happens if you don't? How do you fix accountability? And one possible path could be that if you don't do it in 2 plus 1 year, you have to accept what the value that has been ascribed by the importer. And there, I think this particular judicial precedent by Jharkhand High Court, which has also been affirmed by the Supreme Court recently, might come in handy. Moving on, the second one is in the context of a voluntary revision of import and export entries. So what happens is basically a new section 18A has been proposed, which will allow importers or exporters to voluntarily revise their declarations made in the bills of entries or shipping bills, export documents. Now, this may seem like a very procedural, very hyper technical sort of an amendment, but it is not. Because what it does is it overturns a Supreme Court judgment from 2019 in the case of ITC Limited, which basically said that appeals had to be filed before applying for refund of excess customs duty paid in case you wanted to change your position, in case you felt that SSE felt that they have overpaid by because of an error, because of for whatever reason. And this used to cause a lot of trouble because SSEs would have to spend a lot of time in appealing or going for a amendment of bill of entry and then file for refund. One hopes that with this revision, voluntary revision mechanism being in place, which will treat such revision as a self-assessment, which will automatically lead to a refund scenario if there is a short payment of, if there is a overpayment of duty, that it could crunch timelines in terms of refund, which will be a big pro business, pro facilitation move. Of course, the flip side is that this option is also available if someone has underpaid and wants to make a correction. They can pay the excess, the additional duty that is payable along with interest. The law does not mention any penalty. uh, the Honorable Finance Minister, in her speech while introducing this provision, said that this will entail no penalty. The fact that there will be no penalty has not been specifically brought out. It is there in terms of omission. It is not a specific clarification. Maybe that's something that one hopes will come in by way of a circular, that in such a cases of a revised self-assessment, no penalty would be imposed. But otherwise, it's a very significant amendment that has been proposed. The only exceptions are where audit or a search, seizure, etc. has already been commenced, because the whole idea is that this has to be a completely voluntary sort of a revision of bills of entries. And in some cases, based on certain risk evaluation parameters, the proper officer may verify the revisions and may even reject it if the revision is found to be incorrect. Now, in terms of talking points, what is important to understand or evaluate is, will this revision help in availing input tax credit of differential IGST? What happens is, when you import something, you have a basic customs duty and you have a import GST, which which I have referred to here as IGST, import GST that gets levied on the import. And the question is, often importers struggle. There are disputes that get created. Is, how do you take credit of this import GST? What is the credit taking document? Because technically there are a bunch of documents that are prescribed to be credit availment documents, and things apart from bill of entry were not mentioned. So now, with the bill of entry being allowed to be amended by under this proposed amendment, I think that provision or that problem or that dispute will get obviated. The second thing, and this will probably require more deliberation, is often there are transfer pricing adjustments which brings down the price that have been paid for imports by the Indian entity. In that case, could there be a customs refund on the basis of revision of the bills of entries on account of transfer pricing adjustment? I raised this question specifically to senior customs officers during our post budget interactions. They were not very forthcoming with a clear answer, but I think firstly, we have to be cognizant of the fact that transfer pricing takes a much longer view, a financial year-wide view in terms of arriving at a arm's length pricing, whereas customs is more transaction specific. So a particular transaction of import might have a different transaction value than a subsequent import. But keeping that difference in perspective aside, transfer pricing adjustment could potentially be a relevant input for seeking revision, but I think we'll have to wait for the regulations to come in to ascertain whether, in all cases, a TP adjustment could lead to a customs refund. We need to remember that currently the method that is most adopted is an amendment of bill of entry. Amendment of bill of entry is possible only when there is a documentary evidence. The documentary evidence basis which we are seeking that amendment was already in existence at the time of import. Now, this proposed revision mechanism will be much broader than the current option of amendment, because this particular condition of documentary evidence being in existence at the time of the relevant import is not there in the context of revision. So one expects that this method will be far more popular amongst importers when it comes to correcting errors or correcting overpayments or underpayments of import or export duty in the coming days. The penalty point I have already touched upon. There needs to be a clear iteration of the no penalty rule as was done in the budget speech, whether by way of amendment in this proposed law or by way of a circular. This has been represented. One hopes that this aspect will get addressed. In terms of other key changes with effect from 2nd February, time limits under various compliances under the customs import of goods at concessional rate of duty for specified end-use use have been extended, which should be beneficial in terms of compliances. Settlement commission as a concept under customs and central excise laws will be replaced by what is known as an interim board, and effectively this whole settlement commission concept will be wound down. There will be no new application for settlement accepted after 1st April 2025, and all the current pending applications will be moved to the interim board on an as-is basis. One of the things that was mentioned in the budget was that the current model bilateral investment treaty of 2016 will be revamped and made more investor friendly. Now, some of you in Europe might be aware that in India's negotiations with EU for a free trade agreement, this has often been a stumbling block, the protection afforded to investors, because the current model investment treaty of India is considered a little too one-sided. So one hopes that with the revamped bilateral investment treaty, the FTA negotiations with EU and UK will pick up once again. And lastly, in terms of customs and international trade, there was an announcement about setting up of a multi-ministerial export promotion mission, and this is aimed to facilitate easy access to export credit and, more importantly, support to MSMEs in India to tackle non-tariff measures like environment-based non-tariff measures like CBAM, deforestation regulation in the EU. And maybe now that Mr. Trump is back with his tariffs, our MSMEs would need help to negotiate and deal with those as well. So one hopes that this multi-ministerial export promotion mission will be able to take that aspect also within their remit. Moving on to the rate changes, I mean, I'll not go into the specifics of it, but I think the principle behind the rate revisions is to balance between incentivizing local manufacturing, ensuring international competitiveness, and reasonable pricing for Indian customers, as well as to some extent simplification. A lot of tariff items have been added or have been realigned in terms of simplifications. A couple of new tariff line items have been added. There has been reduction in BCD rates for parts for manufacture of electronic toys, for manufacture of lithium-ion battery for electric vehicles, as well as for mobile phones. So these are some of the sort of samples of the sort of rate revisions that have been brought in by Union Budget 2025. Moving on to GST, one of the key things that have been done is, some of you might be aware that from April of this year, the input service distributor mechanism under GST will become compulsory for distribution of common credits for a company which has multiple GST registered branches across India. Now, this ISD mechanism, the provisions pertaining to ISD, probably it was an inadvertent omission, were restricted to services received within a particular state. Now, obviously, that doesn't work in a GST setup because it is federal in nature. It is, it's works all over, applies all over India. So that gap has been sought to be plugged by this particular amendment. So it will not only cover the ISD mechanism, will not only cover services received from within the state, but also from outside the state. This is, of course, a very reasonable amendment to overcome a lacuna, and I don't foresee any problem with this one. Second point worth noting is deletion of time of supply provision in the context of supply of vouchers. Now, this supply of vouchers aspect has been litigated heavily in India in the last couple of years. Thankfully, now the law is becoming clearer. There was a Karnataka High Court decision which said that voucher is nothing but an instrument of payment, is akin to money, and therefore it cannot be treated as supply of goods. And so no VAT or GST can be levied on that basis. The government seems to have also accepted it. They issued a circular on 31st December of last year stating that vouchers are outside GST. They are not liable to GST. So this deletion of point of supply provision in respect of supply of vouchers, I think, is in line with that and is a welcome move overall. Third point is vis-a-vis pre-deposits in case of appeal. Now, so far, in case of if there is a tax demand against an SSE, and tax demand plus a penalty plus interest demand, pre-deposit for filing an appeal was only applicable qua the tax amount. If someone had a demand notice against them only for penalty and interest, there was no pre-deposit. That is sought to be changed. So now, even for appeals which are only being fought on the point of penalty, there will be a 10% pre-deposit of that penalty amount that would need to be deposited before the appeal gets allowed and admitted. So 10% at the first appeal and 10% for the second appeal before the GST appellate tribunal, which one hopes will become functional this year. So this is a change that has come in. From the perspective of the government, they are saying that we are bringing in uniformity, but I think there is some amount of disappointment around this, that when the only thing at stake being disputed is penalty, why should there be a pre-deposit? But in any case, this is what it is. This is the policy decision that has been taken. So now, from the date that this becomes effective, this provision becomes effective, there will be a pre-deposit mandatorily required even when someone is fighting a penalty. Coming to this, the next point about credit notes. Now, credit notes are a oft-used tool, especially to pass on discounts and for various other, commercial transactions. Typically, what happens is if I have issued an invoice of 100 rupees and there is, say, 20 rupees of GST on that, if I subsequently want to issue a credit note and reduce my tax liability, the law says that my recipient should also reverse credit. So if I am reducing my tax liability by that 20 rupees, my recipient who might have availed the credit of this 20 should reverse this credit also, because there should be no double benefit, which is fine, which is a reasonable sort of principle. The problem is, by this amendment, the responsibility to ensure that my recipient reverses that credit has been completely cast upon me, even though I may not have any control over my recipient's act or omission. Now, this could potentially lead to a lot of disputes, both contractually as well as with the government, in terms of reversal, because what mechanism does one have to ensure that my recipient reverses credit? There was a circular earlier last year. It was issued where there was a prescription of getting a CA certificate, a chartered accountant certificate, from the recipient to ensure that credits have been reversed. But on a practical level, this may become a Herculean task and added compliance burden. In this context, it is pertinent to note the amendments in sections 38 and 39, which omit the term auto-generated and enable introduction of additional considerations in terms of filing the monthly GST return form GSTR 3B. The technicality aside, what it seeks to do is to provide legal backing for generation of form GSTR 2B based on action taken by my recipient taxpayer on the invoice management system. Now, some of you would be aware that currently the invoice management system under GST is at an optional level. It is not being mandatorily enforced. It is not been adopted in a wide manner. Once the invoice management system becomes mandatory, becomes widespread, probably the monitoring of reversal of credit in terms of based on a particular credit note would become easier to track. But till that time, it will probably remain a bit of a additional burden. And I have spoken to a lot of my clients, lot of corporates who regularly issue a lot of credit notes, and they foresee I mean, there doesn't seem to be an easy way out. It will require updation of contracts probably with our dealer distributors to ensure that at their end there is prompt communication and prompt reversal of credit. Their systems are updated, their systems are in sync with our systems in terms of timely reversal of credit, because otherwise reduction of my liability by issuance of a credit note may become a tough call. And this will manifest itself significantly in cases, especially in the FMCG sector, especially in any sector which has a large dealer distributor network, because all sorts of trade discounts, so quantity volume discounts, or preferred dealership programs, a lot of it functions through large volume of credit notes. In fact, there is a ongoing Delhi High Court case where one of the points that a petitioner has taken is that it is impossible for me to get certificates from my recipients for all the credit notes that I have issued since 2017. Is virtually impossible, and on that basis interim relief has been granted. Of course, the final decision is yet to come, but this is something that we see many variations of this dispute playing out in the coming days, because the moment you make someone liable for someone else's mistake, it is bound to lead to legal battles, and it might be challengeable in court. Moving on, uh, there has been an amendment to align transactions involving supply of goods which are stored in special economic zones or free trade and warehousing zones. Now, what happens is, the GST law has always been very clear that sales of goods stored in customs bonded warehouse, till they are cleared for home consumption into the main territory of India, into the non-bonded territory of India, that should not qualify as a supply. That should not qualify as a taxable supply under GST, because those are transactions that are technically happening outside the territory of India. That position vis-a-vis customs bonded warehouses was very clearly coming out from the GST law, but this was not very specifically extended to special economic zones or free trade and warehousing zones. And a lot of FTWZs are used by foreign entities who are storing goods into India for just-in-time sales deliveries. So for them, I think this will be a very useful sort of clarification in the law, and this amendment will be retrospective. It's a taxpayer-friendly retrospective amendment that will date back to 1st July 2017. But of course, if someone has already paid tax, there will be no refund of that. But otherwise, if someone is facing litigation, demands of tax, etc., for transactions of vis-a-vis goods located in SEZs or FTWZs, I think they can use the benefit of this amendment to finish the litigation completely. Which brings me to the last point, which is our not so taxpayer friendly retrospective amendment, which has been brought in to overcome taxpayer friendly judgment from the Supreme Court in the case of safari retreats. This was in the context of input GST credit for construction. In and then the section in question is section 17.5D of the CGST Act. What basically section 17.5D, as was interpreted by the Supreme Court in this case, it was held that credit will be available if the asset or building being constructed qualifies as plant or machinery, or if it can be established that the taxpayer in question is not getting the asset or building constructed on his own account being from the statute itself. And how was on his own account interpreted? That it is not being done for personal use but for usage by the taxpayer as the very basis, as the very means for providing of output services. And the best example of that is a mall. If I am planning to provide commercial renting services to various brands, I need to have the mall. So the mall is the very basis of providing my output service of commercial renting, as opposed to, say, someone creating a office space, which is a premises, which is a setting in which probably activities are carried out. So what the Supreme Court said is, if something is the if the construction in question is of a structure which is the very basis for providing the output taxable activity, that would not lead to a credit restriction. The credit of that should be available. What has happened is this retrospective amendment affects the first part of it, where it said that if it qualifies as a plant or machinery, they have said we'll replace the word or with and. Plant and machinery has a much more restricted meaning under GST, and which will curtail the availability of credit in many cases. So of course, that part of the argument goes once the retrospective amendment becomes notified, becomes effective. But the second part of the definition, second part of the judgment, the interpretation of on his own account, that beneficial conclusion will continue to be available. That would be applicable for commercial real estate. That will be applicable for even public-private partnership projects like a port project or an airport project or a LNG terminal project, where there is a concession arrangement and someone is building a large asset, which is the very means, which is the very basis for providing output services like port services, airport services, or LNG regasification tolling services. So I don't think the last word has been spoken on the issue of credit in the context of construction. One would probably see more litigation on this, but I think the headline conclusion from my side would be that all is not lost. While the retrospective amendment shows the government's intent not to allow credit on this count, but legal arguments continue to remain available. With that, I think I'll close the session on indirect taxes and hand it over back to Maya for taking this forward.
Thank you so much, Adipto. And I will, again, without further ado, so that we, quickly continue, get now to our last speaker, Vinay, who will shed some light on the regulatory developments. Quickly, a couple of words about Vinay. Vinay Joy is a partner in the Employment, Labour and Benefits Practice Group in Khaitan & Co.'s Bangalore office. He specializes in all aspects of contentious and non-contentious employment law matters, including those arising as a consequence of business transfers and integration of acquired businesses. And Vinay is also part of Khaitan & Co.'s Germany desk. Over to you, Vinay. Looking forward to your insights.
Thank you, Maya.
And the presentation is visible, so perfect.
Great, thank you so much. I just wanted to elaborate on the fact that as a firm, we do have a specific German desk where we concentrate on business in the Indo-German corridor. So we have had experience dealing with various complex cross-border matters for German clients, and we look forward to the opportunity of working with a lot of you as well. I now have the easy part to sort of bring this down to cover the non-tax changes that have been proposed in this budget. I think Gaurav and Sudipta have done an excellent job capturing most of the complex aspects. I think I'll move on to something relatively simpler. I think one theme that the government or the finance minister kept mentioning as part of her budget speech was that there were 4 engines for the growth of India, which she concentrated on this budget. And that was with respect to the agricultural sector in terms of enhancement of the agricultural space, a specific focus on micro, small, and medium enterprises, bringing about some general reforms in the financial and corporate sector, and of course, bolstering exports as well. Uh, Very quickly, agriculture, of course, contributes significantly to India's GDP. I think the largest number of people are employed as part of the unorganized sector, which is in the agriculture sector itself. And so, agriculture is typically always a priority. But I think the government has made some very specific proposals this time. It is, I think, firstly, to sort of aid in the availability of credit services and to sort of act as a rural community hub. I think what they have done is made services of the India Post Payments Bank extended to rural areas as well, so that smaller enterprises or agricultural entrepreneurs can make use of insurance services, digital services, and other credit services, of course. The government is also talking about the development of agricultural programs and the initiation of a rural prosperity and resilience program, which is meant to address underemployment in agriculture through skilling, investment, technology, and of course invigorating the rural economy. Now, I think towards this end, what the government proposes to do is to encourage cooperatives and startups to drive innovation in the agricultural field as well. This could be very simply, the development of AI intelligence-driven farming tools to optimize crop yield, or even better applications to track weather and water availability, pest control solutions, etc. I think there's a lot of emphasis on that. Um Also, I think what might be very interesting is the national mission on high yielding seeds. I think the government has made it a priority to, target development and propagation of seeds with high yield, pest resistance, and climate resilience. Now, why this is of particular interest to my mind for foreign investors is that while foreign direct investment in agriculture in general is prohibited in most parts, there are certain avenues within that sector which are available for investment, and investing in the development of seeds is one of them. So this is an area where we can have foreign players come in and look to sort of help out with the particular focus on this sector as well. Moving on, I think I think Sudipta already touched upon the development of MSMEs, and Gaurav also mentioned about the focus on the startup sector. But I think typically the MSME sector sort of is responsible for about 36% of manufacturing that takes place in India. And so I think one of the key measures is to enhance credit guarantee schemes available to them, which is to give them a guaranteed cover of up to 10 crore rupees from 5 crore rupees currently, which will lead to additional credit of almost about 1,500 billion Indian rupees in the next 5 years. I think one key change has also been in terms of the classification of what MSME enterprises are. These are typically classified on the basis of investment made into them and their turnover, and all of those have now been enhanced. I won't get into the specifics of them, but all of the limits in them have been enhanced, which would mean that a lot more of these enterprises would still remain within the basket of being considered an MSME, which provides them with various benefits in any event. The government has proposed a new fund of funds to sort of additionally contribute about 100 billion Indian rupees into the MSME sector. These funds are also expected to receive commitments of about 9 lakh crore Indian rupees, which is significant, showing the drive towards making investments in this sector. I think there is a new scheme to provide loans of up to 2 crores over the next 5 years to first-time entrepreneurs from the scheduled caste, scheduled tribes, and to first-time women entrepreneurs. I think this will be extended to about 500,000 new entrepreneurs who sort of come in. Uh, there is a lot of emphasis on building training programs for online capacity building, entrepreneurship. There is a specific focus within the budget for the footwear and leather sector, the toy sector, and on food processing as well. I think there have been specific initiatives that have been, identified for these sectors in particular. There is also a revision. I think I've already spoken about the revision in the criteria for MSMEs, so I won't go into that again. Um, in terms of the broad reforms in the financial and corporate sector, I think the first big move is the setting up of a high-level committee to review regulations, certificates, licenses. This, of course, in the non-financial sector to modernize outdated regulations, reduce bureaucratic hurdles, and simplify compliance requirements. a lot of you who are familiar with India would know that the government has had the ease of doing business as a priority throughout its 3 terms now, and it is towards that initiative that the idea is to try and cut down on red tape and regulation as far as possible. I think the one blockbuster change that we expect to bring in a lot of FDI inflow into India is a proposed revision to FDI in the insurance sector. I think the FDI limit has now been increased from 74% to 100%. We do believe that this will drive a lot of investment. I think Germany has a lot of larger players as well. Some of them already here with joint ventures, but now they have the ability to sort of come in and set up a 100% owned subsidiary providing the insurance services. I think again, aiding the ease of doing business sort of motto, I think there is also a proposal to revamp the KYC registry and also the existing model of bilateral investment treaties that that sort of touched upon during his session. I think all of this is meant to, of course, introduce a streamlined system so that we can strengthen enforcement mechanism, but also to make it much more convenient for enterprises to keep updating data and making the KYC process easier. I think at least I can say that we have faced some difficulties in KYC requirements from time to time from various organizations, and this was a welcome step to sort of change that. I think there's also a proposal to establish a mechanism under the Financial Stability and Development Council to evaluate the impact of current financial regulations. The Financial Stability and Development Council was something that was set up in 2010 by the then finance minister in the wake of the global economic crisis to try and create an apex body that looked at regulations and means at how regulations at that level could be taken care of so that India would not face the brunt of a recession on account of global factors. So I think the body's role now will also extend to looking at financial regulations and to see where appropriate changes can be made to facilitate investment. There is an introduction of a new Jan Vishwas bill to decriminalize more than 100 additional provisions across various laws. I think this is on the back of a similar bill that was passed in 2023, which had decriminalized about 180 legal provisions. Now, this is very important because I think in the framework of Indian laws, a lot of our laws really have, nominal fines and imprisonment as a penalty that is prescribed, which always makes it worrying for foreign investors or foreign directors to act for Indian companies. I think this will hopefully change that. There is also an expansion in the scope of fast track mergers. While fast track mergers were introduced into the Companies Act some time back, I think the experience for a lot of practitioners and for companies looking to implement that has not been as smooth as we would have hoped. It still takes a fair bit of time sometimes, and I think the initiative here is to try and make it actually a fast track process, maybe expand upon the situations in which a fast track merger can take place, and this will obviously aid business for multiple companies. Lastly, on the topic of bolstering exports, I think Sudipta already touched upon and the launch of an export promotion mission to boost exports. I think government ministries have been asked to sort of propose sectoral targets in alignment with our foreign trade policy to boost trade. I think there's an introduction of cross-border factoring for the ability of doing that for Indian exporters, which will allow them to enter into factoring arrangements with foreign financiers to sell their invoices which are outstanding. It is also a proposal to support MSMEs to tackle non-tariff barriers. Of course, if there are trade restrictions that countries place on exports from countries like India, I think the government has sort of is looking to support those initiatives and trying to see how they can support MSMEs again. And lastly, there's also the talk of a creation of a digital public platform called the Bharat Trade Net for international trade. It will act as a platform where all sort of trade documentation and financing solutions are available for exporters. I think all of this is meant to facilitate, to make it easier for them to access documents and to make it faster. I think there is also availability of credit between the time exports are made and funds are received. The government has also allocated about 2,250 crores towards extending credit to such exporters as well. That, in a very short span, was what I wanted to cover today. We, I'd leave the floor open for Q&A, maybe to all three of us at this time. Happy to take up any questions.
Thank you so much, Vinay. That was actually like I can tell that you were rushing through the presentation because we're actually running out of time. Thank you so much for keeping that in mind.
Sure.
Okay, so dear audience, that's basically your last chance to ask questions. We have already received some questions, especially one that I think we should address here prior to the webinar during the registration process, which I will prioritize now. And then we'll see where the questions come up in the meantime. Otherwise, I think we should close because we're really running out of time, if that's fine with all of you. And it's a bit of a smooth transition because I think that question will be for Vinay. The question we have received is HR related, and maybe you could shed some light on what are the notable announcements in the union budget on HR issues. Was there anything in particular that you or anyone, of course, it doesn't have to be to you in particular, anything you would,
Sure.
anything that was
No, I think,
outstanding?
yeah, of course. I think the union budget did sort of make certain announcements towards the HR sector as well. I think more for employment to create opportunities. I think this government has in general done a lot of focus on skilling, and that is something that has taken a prime example in this budget as well. There is creation, like I said, for new employment generation. I think they've talked about a new employment generation scheme. There is also a scheme to promote global capability centers in tier two cities. All of this is to sort of create employment in those aspects. So it is specifically towards that. I think the main, I think what might have been in the public domain popularly was an announcement with respect to a social security scheme for online platform workers. Now, this is not technically new in that this was something that was already talked about as part of our social security code. But it's just that it's something that has that code has not yet come into force. And now that the government has sort of spoken about bringing about this kind of welfare scheme for platform workers, I think we will sort of look to see how that will work as well. Also, again, I think more funding has been allocated to labor commissioners, to industrial tribunals, etc. I think that is again going towards strengthening because a lot of our industrial tribunals unfortunately lack manpower or lack trained personnel, and which again slows down the judicial justice delivery system. So I think some of those initiatives will go towards that. I hope that's a useful answer for everyone.
I'm sure it is. Okay, thank you so much. So in that case, the only last question that I have, and of course, whatever questions come up in the meantime from the audience, as in even in the next couple of days, can always approach either MIIM or our experts here from Rödl and Partner, Gaurav, Sudipta Vinay, from Khaitan and Co. anytime. The only question that I have as like a last word is thumbs up or thumbs down for the union budget. I have a feeling,
I
as
think
in
thumbs up.
from you. Thumbs up, right? Yeah, that's what I was expecting. I was just hoping for like a resounding. Got up, Vinay? Same, I guess.
Same, yeah, thumbs up. I mean,
Cool.
not much changes are also a sign of stability which India is providing. So yeah, thumbs up for that.
Cool, cool,
Yeah.
cool. Glad to hear that. All right. So in that case, I'll come to my closing words real quick. I'm sorry for rushing through this, but we've really run out of time here. Thank you to the audience for joining us for this webinar today. We hope that, of course, you found it informative and engaging and understand that your time is valuable, and we appreciate that you chose to spend it with us. As I mentioned before, if you have any questions or comments, please don't hesitate to reach out either to the MIIM program or our speakers, and we would be happy to continue the conversation and provide any additional information you may need. I'd also like to take this opportunity and invite you to our upcoming MIIM events. I'll be super short here. We have introduced a new event format, the so-called MIIM Stammtisch events in Köln, München, and Stuttgart. And all three Stammtisch events will take place in March. You'll find all the relevant details as well as the registration link on our LinkedIn handle. And there's another event in Frankfurt. It's called India's Manufacturing Growth and Regulatory Landscape, taking place on 19th of March in Frankfurt am Main. And again, you'll find all the relevant information either on social media or by contacting us directly at mim@indianembassy.de. Last but not least, I would like to once more thank our speakers, Dr. Dinesh Antil, Shodipto, Gaurav, Vinay, as well as the Embassy of India, Khaitan and Co., and Rödl and Partner for the support. Thank you, dear attendees, for your patient listening, and we look forward to connecting with you soon. Until then, as always, stay healthy, and we hope to see you again soon. Bye. Thank you so much, and good afternoon, good evening to all of
All
you.
right. Thank you, everyone.
Bye. Have a
Thank
good
Bye.
you.
day.
Bye bye.
Bye bye. Thanks.